third or fourth week of 2025 and a never-ending January.
It's the last show of January. It's almost over. One more day if you're watching on Thursday.
Yeah, welcome to Freightonomics, where we combine that freight market intel with the global supply chain. Tony Mulvey, senior analyst. Zach Strickland, head of freight market intelligence, here with you to talk about tariffs and all the earnings that we had.
It's been a big earnings week, not only in transportation, but really across the entire market. And I think stock market, that is, not freight market. But what I think you're seeing some signs of maybe the results don't speak to positive signs, but the management commentary, again, that's where I think in the earnings get lost. That's where you need to look, because that's where the nuggets lie and not in the numbers themselves.
Yeah, I mean, uncertainty is certain in 2025. And that is, from transportation providers to shippers. I think that's been the theme of the year thus far. Yeah. I don't know that we've had any definitive answers on much. I mean, we're going to go through some of these earnings calls.
Yeah.
A lot of people, it sounds like you're sandbagging a little bit, but you can hear there's veiled optimism in a lot of these transportation service providers' outcomes. And, the tariff situation is a whole nother bag that we're not going to be able to unpack purely here. But I think getting a little bit of an understanding of why they're used, what we think they're being used for, I think is helpful.
Yeah, just to touch on the veiled optimism, and we'll touch more on it here as we progress through the show. I think you have to remember what these CEOs are trying to do. At the end of the day, they're trying to generate returns to their shareholders. How do they do that? It's by raising the stock price. And so they don't want to come out there and be overly optimistic and then miss, because that's detrimental to their price.
Yeah.
They'd rather set more of a cautious outlook.
Undercommit, over-deliver.
Always. and they're PR trained to do this. So, but with that said, Zach, we need to set the stage on where we're at in the market. So we'll start with the market in 3, 2, 1.
Look at this tender rejection index still hovering right around 7%. And we haven't had winter weather really influence anything this week. I think we will see this fall down a little bit, pending any further disruptions, which I don't foresee any in the near term. But a 7% rejection rate at the end of January, without winter weather happening over the last, I say, 7-ish days of any significance here. We had the last winter storm that coated, blanketed New Orleans and a lot of these port cities down in the southern tier. A lot of that snow melted really quick. So it wasn't a huge disruptive factor. So I'm taking this 7% rejection rate and the stickiness we're seeing in OTRI as a pretty decent sign that capacities erosion has been relatively significant, and it continues to be so. Let's break it down by mode in the next chart, looking at the van outbound tender rejection index in the teal, bluish color down on the bottom, but refrigerated. Oh my God, the reefer segment of truckload is really having a second coming here. And these are, we had a similar situation last year. And my take on a lot of this, as I've talked to numerous carriers and brokers, they're kind of cautiously optimistic that this is really a big sign that cycle has turned for them largely. Doesn't mean they're out of the woods yet. Same thing happened last year where we had a big snapback moment. If you look at this index in March, April of last year, refrigerated tender rejection rates fell back down to the van level. It's hard to imagine that happens again this year. I think 17% rejection rates are a little bit more telling than the ones we had last year. Let's move on to demand and talk about the OTVI in our next chart. Demand is really underperforming last year, but we've had a little bit of a surge to start this week coming out of Martin Luther King. And I'm still not super bearish on demand to start the year, Tony, but I do feel like this has a lot of potential. Yeah. I'm coming around a little bit that maybe demand does have a chance.
Yeah, I think the demand side's interesting. Lunar New Year underway. It's kicked off yesterday. So I think that might help. I mean, things were moving. I mean, we were still positive year over year on the ocean side. A lot of that
freight doesn't come in.
I know it doesn't go directly into the truckload market. It's a matter of where does it flow? Eventually, it's coming into the country. It's a matter of when does it move
Yeah, Lunar New Year, of course, for those of you that don't know, that's when a lot of the production shutdowns in Asia, China primarily. It's where a lot of our goods are made, and shippers import a bunch of stuff in front of that. And there's a big wave of imports that hits the coast, primarily Los Angeles, Long Beach. And that gets largely shoved into warehouses, thrown on intermodal. There's not a huge sense of urgency around that freight because it is pull forward freight. And that segment is telling us that shippers are importing a lot of stuff.
Yeah, it's very similar to last. I mean, it's like eerily similar to last year. The difference in this year and last year, though, is we've been pulling freight forward for 6 months, right, in front of tariffs, long peak season. So I think that's an interesting element when looking at it.
Yeah.
But I think the hidden part is we've kind of talked about MLK Day as not being maybe as impactful to freight demand. I think it's becoming more and more impactful.
It
and I only say that because really there's nothing between now and Memorial Day. Yes, you're coming. It's not as impactful as Christmas and New Year's, and it's not as impactful as those later holidays. But I mean, you've seen a steady drop each year in the last 3 around this holiday. So like there is some level of impact. Again, shorter and people are starting back to work. So it's like they're not taking off extra days around it like they do Memorial and Labor Day, 4th of July and the like. But there's still an impact there.
Yeah, for sure. So let's move on to the stories of the day. We have a lot to cover today. A lot of the headlines, and we're going to interweave the tariffs into this, but I think we want to start things off with a couple of articles. The first one from John Paul Hamstead, writing that the trucking market is still headed in the right direction. And what he means by that is, of course, that the market has tightened. We've lost sufficient capacity to make sure that, carriers are able to operate in a healthier way, having enough demand to support their supply.
Yeah.
Although that's not completely true for all the carriers just yet, because we're still seeing carriers leave the market.
Yeah.
We're still seeing capacity exit. So it's not like when we say that the freight recession has ended or, we've transitioned. It's that directionally we are now getting to a point where carrier operations are now becoming easier.
Yeah, we're getting to the true inflection point, right? Like things have stopped getting worse.
Right.
And they're starting to trend better. I mean, I think the subheading on that article is probably the most telling is the spread between spot and contracts tightened. Yeah. I looked, I guess last week, PPI, 41 cents. Well, if you would have looked at 2019, the average in 2018 was 42 cents.
Right.
So, I mean, to me, it's telling that we are in a state of that, which if you go back to 2019, especially the back half of 2019, we were, and the difference is we're trending that way, right? It's tightening. It's not like it's just stable at that same level. So and as it tightens, from a shipper perspective, the market starts to feel tighter because, like, even if it's like
this time last year, we're at a
70 or something. It was crazy.
The rejection rates were down around 4%. Actually, they were 5%. We were coming out of that winter weather moment, but now we're at 7, and we're again coming out of a winter weather moment to an extent. And the next story that I want to bring into cites the weather as a potential false positive in the market, that weather has been influencing some of the positive changes they've seen. Knight Swift CEO comes out and says that there are improving data points over the past few weeks, but said it's still too soon to say the truckload market has seen a meaningful positive inflection. And this is CEO sandbagging to a T. Their earnings numbers, remove his words here. Their OR improved. Their revenue isn't up necessarily year over year. They've obviously made some improvement to their operational situation.
They're shredding equipment they quickly. 6% reduction in their truckload average tractor count. I mean, that tells you everything you really need to know is you're still in the state of capacity exiting, and the largest players in the market are still parking equipment.
Yeah, and I totally agree with what he did here in terms of saying, like, we need to be, cautious about calling anything too positive. Like you said earlier, the investors and how that influences them. We this is an unlike most cycle turns we've seen in at least my experience, in the way that we're kind of had the gradual shift. Most market shifts are relatively violent at some point. We've talked about maybe we just weren't looking at it the same way as we do today, but I think a lot of people are cautious because it has been such if you looked at the rejection index, it's such a slow grind.
Well, it's that. I think it's you look at the demand side, right? And like you don't see major growth.
Yeah.
You get the GDP number this morning that was up, right? Like in the 2%, 2.5% range.
Yeah.
But under expectations, I think the interesting part there is what consumer spending was what drove that higher. Service is good spending, a lot of the goods. And it's interesting in this release, it talks about the things that consumers were buying, motor vehicles and motor vehicle parts, specifically light trucks, which is interesting because we've talked about automotive being kind of a risk.
Right.
And I think it leads to tariff discussion and the like. But I do think it's interesting that you've kind of had volumes grow close to in line with GDP and really closer in line with consumer spending growth. And I think that's really telling. It's like, you're not getting a 10% swing in demand. You're getting demand that is growing with the consumer and the overall economy, which is, from a shipper perspective, is what they're looking for.
Sure.
That's what they want stable. From a carrier perspective, because we grew so much from the capacity front, you have to turn that excess off to now get it back into alignment with that growth.
Equilibrium. And from a transportation provider standpoint, I'm not worried about the demand situation.
Like demand fell off. It fell off a cliff relative to during COVID, but it didn't fall to 2019 levels.
Yeah, but also this is a supply side issue.
Yeah.
This is capacity is leaving the market. Knight-Swift cut a lot of their capacity or parked a lot of their trucks, and that's what's going to make this market turn, and that's why I would actually be more confident in calling for a better outcome for the next couple of quarters for these carriers than I would be in traditional sense, because most of those cycle shifts in the past have been resulting of unforeseeable events.
Well, I think the other factor is you look at revenue per loaded mile, ex-fuel, down 0.7% year over year. It was up sequentially in the quarter, which you would expect to probably see some of that. But to me, the one right underneath it, revenue per tractor, you saw that's up 1.7% year over year. I think there's positive signs when you start. The headline numbers are going to get the attention.
Cutting costs, because they knew that they were, nobody's ready to commit to that.
But I also think it's a sign that hey, maybe they took less volume too, and have churned some of their, I don't want to say bad customers, but the lower end contracts to keep higher paying freight, and they've been successful, but it sets them up for this next cycle.
Yeah. Well, let's turn to the economics for a minute here with the next article written by Noy Mahoney, who covers a webinar. Trump tariff threats leave supply chain stakeholders scrambling for answers. This was an extremely well-attended webinar. Greg Tomsett, Vice President of Customs Brokerage USA at Cooney Nagel, had a lot of good insights here, but I'd actually asked ChatGPT to give me some potential impacts of tariffs just for fun. And again, this is a statistical LLM model. It's basically going to just regurgitate what the internet says at this point. But higher prices are one of the potential impacts. So basically, you'll have to pay more. Obviously, that's a near-term thing. For sure, you'll have to pay higher prices if those tariffs, they're largely getting passed along to the end users in these situations. There have been studies done that support this. Supply chain disruptions. This is a big duh. As some of these companies, it takes a long time to figure out where do we procure our goods, where do we send our goods, where do we get them from, et cetera. Creates some hiccups. Then you have the whole political component of retaliation from these countries. Jobs, actually, in the near term, you lose jobs. And then there's potential growth in the long term because a lot of those jobs that are dependent on the current supply chain setup will get shed.
Yeah. And then when you bring things, manufacturing and the like, back to the U.S., you basically are shifting jobs around over the course of a period of time.
And this next one is interesting to me because you don't normally think about it, but we actually produce weaker currency values from other countries versus the dollar. The dollar strengthens. That's not necessarily great if the dollar is so expensive that people can't afford our stuff. So It's China has notoriously been weakening their currency.
It makes the
goods
exports harder from a U.S. perspective. Now, the question is that what the administration wants, right? Like, I have spent a lot of time looking at oil in the past week, and I mean, you start looking at some of like the crude oil stocks outside of the SPR, so that Strategic Petroleum Reserve, like they're extremely low. But we have all-time high production. At some point, I think you're going to see an administration, who's already called on OPEC to drop prices. Like, I think you're going to see them. They're going to try to continue to push higher production, but they're just going to end up holding some of that. But I think what it does is there is a risk around the export market for what the oil that we're producing here. If people can't buy it because the dollar is more expensive, well, we're just going to hold it, and it may be what they want because it may actually lower prices.
Yeah, it actually may encourage growth outside of our borders, which is the opposite of what you want.
Yep.
Trade relations, an obvious fallout there. But I think Greg Thompson comes in and says he doesn't necessarily think this is going to materialize in an actual execution of a tariff on February 1st. And for those of you watching after that this weekend, you're going to know the answer. But normally you don't see deadlines 10 days out. Basically, they could have just implemented them right away as soon as he got into office. That's obviously not what he wanted to do. He thinks that it will get deferred until the new UNSCA in 2026. And then, of course, the politicians will position it as wins from both sides, as it's like, look at my negotiating skills. Look what I did. And they will both cite what they get from the long term. So it's kind of like a public posturing, if you will.
Yeah. Well, it's already happened. I mean, you look at what happened in Colombia this week, right? I mean, that was a very quick, hey, we're going to put tariffs on you very quickly if you don't take basically a plane full of deportations, and within a few hours it was resolved and no tariff. So it's being leveraged as a bargaining chip. I think it will continue to be until somebody's going to have to call the bluff and be like, you won't do it. And that's when it will get really interesting, is if somebody does call that bluff, or if it's a bluff.
One or two,
like somebody's going to have to make a stand up and be like, no.
Yeah, the arguments I've read are like, this is such a broad and blanketed approach, a shotgun, if you will, of threats.
Yeah,
that it's hard to say that all of them will resolve the exact same way.
Yeah,
obviously you can't threaten all the time and not deliver. Like, you lose people stop paying attention to you. So this is going to be some posturing more than likely. I agree with that. But the chances of some of these falling through or getting followed through on, I think is that there's enough of them out there. You just run the numbers.
Something's going to happen. It's just a matter of when and who and what is the magnitude of it.
And that may not be comforting to the shippers out there, but I think the early phases we're less likely to see something fall through. But as we kind of move forward, that's a different story.
Yeah. I think, and this is not something that's going to play out over the course of this year. It's probably going to drag out the entire 4 years, just because
and what one tariff or policy does influences the others downstream. So speculating on this becomes almost an impossibility.
Yeah. I mean, you have to think about, I think of like a Walmart or a Target, right? Where they're shipper, but they're bringing in other goods. They're not really creating anything, right? They are to some degree with private label, but they're still buying that from someone. So they're buying it. So it's like, it may not be them that's hampered by a tariff or something like that, but it's the person that produces that might be impacted. So it's like, it's not just the impacts of one, like there's so many different levels to it that
the complexity here is off the chart.
Yeah.
And that's what makes it hard. So I think the advice to the shippers, supply chain managers out there is, you're not going to be able to commit to a sound strategy for a minute. And so therefore you're going to have to kind of float through a lot of the year.
You're going
to have to go back to some of this just in case. Risk management is going to be a theme.
You have to be able to be nimble.
Yeah.
And I think this is where, like, we've talked about it a bunch. It's like,
that's inflationary too, by the way.
It costs more because you're on your heels. You're reacting. You're not in the proactive getting ahead of things, because even if you are like, okay, if you bring too much stuff in and things don't happen, well, now you have it all sitting here. So it's an inventory cost instead of, the cost to import it. So it's just like the cost get redistributed, and it can be expensive.
Yeah, these things are interesting right now, and I think obviously Trump has proven to be relatively disruptive by nature. Some of the disruption is probably needed. I'm not going to get into the politics of it, but I think if you have too much in such a scale, it becomes counterproductive at a certain point.
Yeah.
And we're going to have to get some stuff nailed down throughout the first part of this year if some of these companies and supply chains are going to be able to actually not be inflationary or not be so disrupted that they actually are efficient.
Yeah, 100%. I think the next news story, touching on Heartland. Heartland, I think this is going to be the most interesting one. And I say that because it's a company that always made money, but they're just
kind of like the poster child of operations from a carrier perspective. They're well regarded. All of a sudden, out of nowhere, and in 2022, they
6 straight losses.
Six losses, and their OR jumped from in the 80s to the 100s. And it's largely been blamed on 2 purchases they made at the end of the cycle in 2022.
I think that hurts them more than anything. They bought at, I would argue, the worst time to buy. Now, I can maybe understand it from that's what they were trying to, if they were buying it to expand things. But I think the timing of it was a challenge. But you look at it, revenue ex fuel, down now almost 9%.
Yep.
Adjusted OR of 98.9%, a 400 basis points worse than it was a year ago. Little older tractor count or tractor age, so slightly older equipment. Well, I think what's interesting is when you actually go into their earnings
gains on sale. If you eliminate the gains on sale, they actually did have an improvement in their OR,
which
that's the number I'm taking away.
Good, because
this tells me that they're progressing, and what probably happened here is they bought some bad business, and they were bought for these companies were sold for a reason. They probably weren't operating very effectively, and sometimes this happens where you purchase bad accounts, you purchase bad business that aren't making money, and certainly it looks like their network did not fit very well with Heartland's model, and it's taken them a whole year.
So in their press release, it actually breaks out. They broke it out, their legacy business. So it was in their legacy business, so Heartland Express and Millis Transfer, 96.3. First quarter of last year, it was 99.9. So 360 basis point improvement through the year. But the CFI and Smith Transport, those 2 acquisitions, the big acquisitions that they made, they've made improvements too. But the first quarter of last year, it was 109.7, and it's down to 102.6. So it's making improvements. It's just, it's taking a while to
really hard to fix bad business in a down market.
Yeah.
Because you don't want to fire customers when you need freight to move.
Yeah.
And that's the bottom line there. So last but not least, JB Hunt, record intermodal loads came with higher costs in Q4. We get a little bit of note from Shelley Simpson here about not being as positive on the outcome. Shelley Smith may be the smartest at playing this game on the public sector of anyone that I've seen. I think there's some sandbagging here. She's got this unique business model in the space. Knight Swift is relatively similar.
The problem is it gets misconstrued as a trucking company, and it is just not. At the end of the day, it is not a trucking
company. It's an intermodal and dedicated operation primarily. They have trucking and they have brokerage, in a final mile sector.
They're small relative to the other 2.
The other 2 are pretty large. Intermodal, of course, they saw some revenue fall there in Q4 versus Q4 of 2023. They cited a little bit of issue with BNSF that has now been resolved. And the number of loads was up. Guess what? This is a pricing issue.
Yeah.
We've said it before. Intermodal has been gaining share for the last bit, and it's because they have not raised their prices yet.
Yeah, there's been no reason for them to. They can grow. I think that's kind of what I think you were alluding to in the kind of sandbagging. It's like she knows that they haven't attacked pricing. They've taken share. The second that the truckload market really starts to transition, it gives them that opportunity as we've already grown the volume. We're clearly servicing it.
Yeah.
It's just going to cost you a little bit more, and that's when you're going to see this just tremendous growth.
And JB Hunt knows exactly what they're doing.
Yep.
Their brokerage revenue was down, but guess what? Their profit margin was up.
Yep.
They know how to manage their business portfolio. I'm not super concerned here. I see lots of positive on this one.
Yeah.
And I can tell you don't want to commit to it yet because nothing is ever granted, and the amount of knee jerking that we've seen over the last few years,
I think that's the part that
all-time high.
Scary.
Yeah,
you just never know where things are headed, but at the moment it seems like we're headed in a positive direction.
Yeah, take what you can today. Have a good week.